Morning, everybody. Thanks very much, Adrian. Well, extraordinary events, really, but then again, I guess where the European or the Eurozone's involved, nothing really is extraordinary these days. But you've got to wonder what's going on, really, as to, well, when I say what's going on, what the European Commission, the IMF, the European Central Bank are doing, because it seems like whatever's suggested, whatever news we hear, nothing seems to resolve this. And yet, I was listening to. Good morning, Peter. Morning, hi everybody. Sorry, I just missed your hellos. It's just extraordinary when you think of the news that's taking place, what could have been done a year or two ago. The fact is, this time last year, the markets were riding okay, and then we had this precipitous fall in August last year. Even then, people thought, I wonder what can be done. Is it too late? We've had another 10 months. The problem with politicians, and this is a political issue, I know it's a financial issue, but it's run by politicians, and they don't go well together. Politicians worry about their jobs, and that's the main issue that one of the main issues at stake here, because politicians come and go. Sarkozy's gone. There's been a wave of changes in government, etc. We've got a referendum today in in Ireland to okay this new fiscal pact. You've got riots, etc. now against austerity. Austerity 2 years ago was supposed to be the buzzword, and yet for a lot of countries it seems to have failed. Certainly for the likes of Spain and Greece, and now you've got parties that are anti-austerity that seem to be coming to the fore. Even in Germany, in Angela Merkel's heartland in North Rhine-Westphalia, a couple of weekends ago, she saw her share of the vote collapse from 36% down to 25%. It's significant. If that happens again in a year's time, Angela Merkel will go the same way as Sarkozy. Morning, Richard. Good. Okay, well, so the picture is pretty murky. I know you heard Adrian just talking about the DAX, etc. I think for the time being, this morning, we're just in a little bit of... Markets don't go down in a straight line. Again, we're just experiencing a little bit of that sort of breathing out, exhaling of the markets. As we see a little bit of profit taking. We've got the FTSE up 35. Not surprising to see a little bit of backing and filling there. Dollar euro certainly off its worst at the moment, 124.04. Really, all we can do is to look to short this market. I do understand and take Adrian's point that we're pretty overcooked. But if you look at the longer term charts, and I know John was mentioning this on Monday, euro was definitely going down. Didn't disagree with that at all. I think it was just at the time the charts were sort of a little bit sort of mixed. I certainly think, 2-3 days later here, that the opportunities, there are definite signals that this market could go quite a bit lower. And the Eurozone, going back to this Radio 5 Live day today on the radio, they've got this... They've got correspondents in Madrid, in Dublin, in Athens, in Frankfurt, and it's a pretty gloomy picture. The reason why I'm talking about all of this is because a lot of the data doesn't really matter. I'm just going to just give you a brief glimpse of the news. This is what happened yesterday, and this is what's happening, and the reason why the euro is taking quite a hit, and the reason why equity markets are suffering. There is what we call a flight to quality or safe haven. Now, the biggest safe haven is the one that doesn't involve the euro, is the US Treasuries. So that is one of the reasons why the euro has weakened against the dollar. A lot of players are selling the euro, buying dollars, and using those dollars to buy US Treasuries. Those are government bonds issued by the US government, the US Treasury, which are 100% guaranteed. They've probably got the best credit rating, despite what some of the rating agents say. Certainly a lot better than the mayhem that is happening in Europe. So that's what's happening. We're seeing a rush into safe haven buying. Treasuries, bunds. What's also happening is anyone who wants to keep their euros is putting them into bunds, short-dated, long-dated bonds. These are the German bonds. And the yields on those have got to ridiculous levels. 2-year Schatz apparently are close to zero. So if you want to put your money away for 2 years, you get nothing on it. You do get it back at the end, though, which is the good news there. Other than that, gilt yields are sort of close to 1.8%. Extraordinary moves, actually. Bit bizarre looking at what actually happened on the markets yesterday. If I look at cable, bit difficult to explain why cable is so weak, bearing in mind there's been massive flows into gilts. The gilt market yesterday went absolutely nuts and was up something like 130 points, which is a very, very big move for the gilt market. So to buy gilts, you need to buy sterling, but sterling was pretty weak on the crosses. And I can, just showing this on the bottom right chart, you can see how much it fell yesterday, certainly from the 157 level to the 155.5. We're now trading at 154.86. So significant moves there. Other news, and I'm not, you know the data that's coming out, so I'm not going to waste your time going on about the non-farm, etc. We know what impact it could have in normal days, but the fact of the matter is there's a lot more else going on. The safe haven rush, the problems with Spain now. Spain is the big problem now. Here's some of the headlines from the FT. Pressure on Madrid to probe Bankia's fall. There was a release yesterday at midday from the European Commission saying that they were considering using the European Stability Mechanism to prop up. Sorry, this was coming from Madrid. I apologise. To prop up Bankia, which basically suggested that Madrid was going to use Spanish government bonds, give them to Bankia, who was then going to use them as collateral at the ECB to get loans, and the ECB just came out and said, no, that's absolutely ridiculous. There were a number of other suggestions as well. In the end, the Germans came out and said they just wouldn't accept it, and it was a bit blindingly obvious. The fact of the matter is, Greece has to leave the euro if they want any short-term solution. If they do leave, there'll be 6 months of Armageddon. The only other alternative is for Greece to stay in, and Germany is going to have to pay for it. That's it in reality. That's it in a nutshell. So other consequences, other issues happening? Well, obviously it's hitting a lot of the equity markets as well. Currencies, not only was the euro particularly weak against the dollar, it was very weak against the Japanese yen as well. That's hit the lowest level since January this year. And any of you that trade euro yen, I'm sure you'll be aware of what's going on there. Pretty bit of a nightmare. And as I say, I think this the pressure on Madrid, the pressure on Spanish bonds, this 6.7, 6.8% yield now on the Spanish bonds is very close to this 7% where basically the shit hits the fan. And it's deemed that it's unsupportable, i.e. Spain would then have to go to the IMF, European Commission, whoever it is, for funds to see it through. And I think that still looms large. And I just think at this stage, Eurozone bonds, some sort of central guarantee of Euro debt in the Eurozone is just not going to happen. If it does, basically what will happen to Germany, Germany's credit rating will be downgraded, and bunds will collapse. And it's something that the Germans, with their sort of fiscal rectitude, are highly unlikely to agree to. Okay, very, very quickly, the other point that I would make, there are a number of other things that are hitting the markets as well. We've had very poor Indian GDP overnight. Brazil has cut interest rates to record lows. Remember the BRICS? Remember the Brazil, Russia, India, China? You know, it's all starting to unravel. And the reason why I mention this is because this is quite interesting. Look at this article here in the FT. Commodities hit by Eurozone fears. It's all adding up to pressure on some of these big markets, a lot of the commodity markets, which is affecting the likes of the Aussie dollar, the Canadian dollar. So just it tends to sort of all tie in, really. They talk about this super cycle in commodities. We've had a decade-long boom in commodities, And the big question is it over? I thought I'd very quickly, before I pass you back to Adrian, I'm just going to show you a little collection of charts I put on some commodities. Again, this is similar to the one we did the other day. I've just done a new one looking at some commodities. Top left, crude oil. Anyone want to know what's going on with crude oil? There's a chart of crude oil. You know, back in March, we were trading at 109.20. This is the West Texas intermediary, so this is the light sweet crude traded in the States. But you can see it's come off about sort of $25, maybe a little bit less. It's a significant move, highly significant move at a time when other commodities as well are coming off. This is largely due to the dollar. I'm not going to show you gold. Everyone knows what's happening in gold. I know gold had just an amazing day yesterday, but there are other markets to trade as well. Copper. Look how much copper's fallen. This is the daily chart in copper. This is really breaking down. Other markets, this is coffee on the top right. Coffee, very, very heavily traded commodity and a very popular market to trade. But look how much it's fallen. I mean, these are significant moves. We were worried about inflation. We were worried about God knows what. Remember, this time last year, our inflation was way, way high. There's no pressure at all now. If anything, the concerns from some quarters is deflation. Bottom left, cocoa. Middle left, middle bottom, sugar, all falling. Corn, bottom right, all falling. These markets are moving lower. One of the main reasons is the dollar, and a lot of commodities are priced in dollars. And when the dollar rallies, all dollar-based commodities come off, and that's what we're seeing quite markedly. And remember, this is having an effect on these commodity-based currencies, the likes of Brazil, the Brazilian real. They depend on high commodity prices, coffee, sugar, the likes of Chile, copper. Russia is very commodity dependent. Obviously, Australia, totally commodity dependent. As soon as they stopped shipping off all their iron ore and God knows what to China, and that has really slowed down, all they've got left is a really overvalued currency. And the Canadian dollar, same thing, a commodity-based currency. So you can see why all this is happening. And just believe you me, look at the long-term charts on some of these currencies if you really want to know where they can go. I'm going to leave you be for now, just to leave you with the calendar just for today. As I say, I'm not going to waste any time on it, but ADP employment change today, followed by non-farm tomorrow. Those are the key bits of data. The news that was out so far this week was weaker than expected, but really it's been overshadowed, way overshadowed by the Spanish woes and the Eurozone peripheral bond crisis. So expect more of the same, I suspect, certainly till the end of this week. Thanks for listening.